Economic stability is a situation in which a country does not show large variations in its main macroeconomic indices. The most important are inflation, unemployment, and gross domestic product. In general, an economy is considered stable if it shows little progress in GDP and the level of employment. Similarly, the average rise in market prices should be minimal. Another point to mention is that in order to achieve economic stability, governments apply fiscal policies and monetary policies. Thus, they entrust their central bank, for example, to intervene to keep the exchange rate within a certain range. The most important indicators of economic stability are the following: modest economic growth, low and stable inflation, minimum unemployment, low fiscal deficit, stable currency, and equilibrium in the balance of payments. The main reasons for pursuing economic stability are as follows: generate confidence in a capital and create certainty for customers. On the other hand, the term financial stability has been used more and more since the beginning of the financial crisis. Experts may define these concepts slightly differently, but they all agree on its importance. In other words, when citizens can continue to have access to their bank accounts, companies can continue to make and receive payments, investors can continue to make investments, and banks continue to finance themselves with loans from the industry to the central bank. Stability is a matter of balance. The financial system is characterized by a complex network of dependencies and interactions between different agents. Bank and insurance companies act in intermediaries, channeling funds from those who wish to lend or invest to those who wish to obtain financing. Financial markets such as money and fixed income markets also bring lenders and borrowers directly into contact. Meanwhile, the payment and securities settlement system, which function as the arteries of the financial markets, guarantee the safe flow of monetary and financial assets. Risk can arise at different levels and take different forms. A general slowdown in the economy raises the level of indebtedness of homeowners and causes their properties to lose value, while the credit institutions that finances their mortgages may find themselves with clients without the means to meet their debts. A slowdown in emerging markets can harm the economy, for example, by reducing demand for goods, leading to job losses in affected sectors. It can also lead to a cascade of selling in a debt, equity, and currency markets that markets in difficult for companies to finance, slowing down economic growth. Thus, the risk in vulnerabilities. What are three central propositions that you could offer to solve the problems of unemployment and high inflation in the Mexican economy? The world economy is experiencing the largest contraction in economic activity, production, employment, consumption, and trade in a 7 or 8 decades. The adult and young generations that now make up the economically active population, as well as those who make decisions in political and economic matters in various nations, have not had a cursus. The well-being of the population experiences a similitudes way of vulnerability reduction in certain regions that have been growing dynamically while underlining the expectation and limiting the possibilities of great basic satisfiers for the majority of population in less developed countries. Number 1. The state must recover the regulation of economic activity. Number 2. Forgetting debt service must be renegotiated. Number 3. Overcome internal production lags.